In today's episode, we are analyzing technical indicators. As new traders, you will be lost when you will realize how many are out there. Indicators are part of technical analysis. Most of them look really fancy, however, still, no one is perfect. In the description, you will find more details for each indicator we are analyzing here. Bollinger Bands. We explained ribbon indicators in the previous episode, but now we will go a bit deeper. You are filling your toolbox with each episode, and I'm really glad you came so far. There is a lot to know yet, and even if you do, you will have to discard even more. You will understand what I mean in future episodes. John Bollinger was the creator, even though the idea was not new. Most technical indicators were created in the end of 70s and 80s, when we started to have huge amounts of data and calculations computerized. However, this didn't increase success. 90% of the traders are losing money in the market, no matter how advanced AIs and automations we have. Bollinger Band is a technical analysis tool. The bands measure the relative high or low of the entity we are trading in relation to previous prices, overbought and oversold. Remember what we said about these terms. Yes, you will see them very often, and here they are again. As we said, there is no overbought, oversold in the market. These are just some market extremes based on previous prices. This is how the indicator will look like a river that follows the prices. The upper and the lower limits measure volatility over time. The formula for those who are interested again will be in the relevant video. From a first look, we have an upper limit, a middle and a lower one. For most platforms, the initial values would be with a period 14 or 20. Of course, you need to change the values to get the idea. Here we have the standard deviation, a very helpful indicator, and I suggest to watch it if you want to understand the values. The higher the value, the wider your channel. Those of you who are familiar with statistics and standard deviation probably know what 1, 2 and 3 means. Prices tend to return to the middle line. Bollinger Bands provide dynamic support and resistance levels. Don't get fooled. This is another lagging indicator that follows the market. The longer the time frames, the stronger these bands tend to be. Many automated systems out there are using these bounces. When the bands are expanding, you need to avoid trading. This means that the price is moving a trend and not ranging. When the bands squeeze together, the market starts to build momentum, which usually means that a breakout is most likely to happen. Of course, when you are trading real markets, this won't be a rule. If the candles start to break out above the top band, then the move will usually continue to go up. If the candle starts to break out below the bottom band, then the price will usually continue to go down. Of course, we don't know how up how down. This is how a typical Bollinger squeeze works. The idea is to catch a move as early as possible. Again, you will face fake outs, but stay with me. Typically, when the market is trending, you can trade the indicator by placing a buy or sell order to those overbought or oversold areas. Again, try that with some demo accounts and you will come back to thank me when you will realize that it doesn't work. You will get fooled many times from the fake signals. Another indicator that I have analyzed separately and one of the least popular is a volatility indicator created by a grain trader named Chester Keltner in his 1960s book How to Make Money in Commodities. Again, the formula has been provided in the relevant video for those who want to go deeper. However, the midline in a Keltner indicator is an exponential moving average, and the two outer lines are based on the average true range, the ATR, rather than a standard deviation that we are using in Bollinger. Because the channel it comes from the ATR, the average true range, which is a volatility indicator itself, and again is being provided in the description. The Keltner channel also contracts and expands with volatility, but is not as volatile as the Bollinger Bands. Keltner channel serve as a guide for getting trades, entries and exits. The Keltner channel help identify overbought and oversold levels relative to a moving average, especially when there is no trend. Think of the channel like an ascending or descending channel, except it's automatically adjusts to recent volatility and isn't made up of straight lines. Bollinger and Keltner looks almost similar, but the calculations are not. All formulas have been provided in the relevant videos. I suggest not looking at them until you fully understand the concepts. The principle here is the same: movable supports and resistances. The top is a dynamic resistance, while the bottom a dynamic support. The most commonly used settings are 2 ATR with a period of 10 for the upper and the lower lines, and an exponential moving average with a period of 20, which is the middle line. You are already pro in moving averages, so you are getting the idea fast. This middle line is pretty significant since it trends to act as a pullback level. during ongoing trends. In an uptrend, the price action tends to be confirmed in the upper half of the channel, which is between the middle line as support and the top line as resistance. In a downtrend, the opposite. Price action usually hangs around the bottom half of the channel, finding resistance at the middle line and support at the bottom line. In a ranging market, price usually swings back and forth between top and bottom lines. The principles are the same. If the candle starts to break out above the top, then the move will usually continue to go up. If the candle starts to break below the bottom, then the move will usually continue to go down. Keeping an eye out of these channels breakouts can help you catch a big move as early as possible. MACD, Moving Average Convergence Divergence, one of the most popular indicators out there, and in most platforms it will be one of the first that will pop up in your graph automatically. This technical indicator is a tool that is being used to identify moving averages that are indicating a new trend, bullish or bearish. This is the reason I told you that the MA is a chapter you need to master first. MACD was used in technical analysis of securities prices created by Gerald Appel in the late 70s. It is designed to reveal changes in the strength, direction, momentum, and duration of the trend in an entity. The first thing we need to identify is a trend. With a MACD, you will usually see three numbers that are used for its settings. This is how indicator will look. The first is the number of periods that are used to calculate the faster MA. The second is the number of periods that are used in the slower MA. The third is the number of bars, the histogram, that are used to calculate the moving average of the difference between the faster and the slower moving averages. 12, 26, and 9 are the MACD parameters, which is usually the default settings. This is how you would interpret based on what we said. The 12 represents a moving average of the previous 12 bars. The 26 represents a moving average of the previous 26 bars. And the 9 represents a moving average of the difference between the two moving averages above. There is a very common confusion when it comes to the lines of the MACD, especially for beginners. For example, this is how the indicator will look in most of the platforms. Notice the two lines. You might also see it with just one line. The reason is very simple and we will explain. You can pick whatever you prefer. Personally, I'm familiar with just one line. So let's examine the basic components of the indicator. As we said, there are two lines, the MACD line and the signal line. The two lines that are drawn are not moving averages of the prices. The MACD line is the difference between two moving averages. These two EMAs we said earlier. The MACD line is considered the faster moving average. The MACD line is the difference between the 12 and the 26 period moving averages. The signal line is the moving average of the MACD line. The signal line is the slower moving average. The slower moving average plots the average of the previous MACD line. This would be a 9-period moving average. Most charts use a 9-period exponential moving average by default. This means that we are taking the average of the last 9 periods of the faster MACD line and plotting it as our slower moving average. The purpose of the signal line is to smooth out the sensitivity of the MACD line. So finally we have the histogram. Simply shows the difference between the MACD line and the signal line. The bars are the distance between these two lines. It may sometimes give you an early sign that a crossover it might happen. In our example, you can see that as the two moving averages, the MACD line and the signal line, separate, the histogram gets bigger. This is called a MACD divergence because the faster moving average, MACD line, is diverging as moving away from the slower moving average, the signal line. As the moving averages get closer to each other, the histogram gets smaller. This is called convergence because the faster moving average is converging or getting closer to the slower moving average. I think now makes sense. Moving average, convergence, divergence. So how it works? When a new trend occurs, the faster line, the MACD line, will react first and eventually cross the slower line, the signal line. When this crossover occurs and the fast line starts to diverge or move away from the slower line, it often indicates that a new trend has formed. When the lines cross the histogram, temporarily disappears. This is because the difference between the lines at the time of the cross is almost zero at some point. As the downtrend begins and the fast line diverges away from the slow line, the histogram gets bigger, which is a good indication of a strong trend. In the description you will find a much more advanced video for the MACD and how to use divergence at a more advanced trading level to identify when the trend is running out of steam. But for the moment, stick to the basics. Parabolic SAR, a beautiful indicator you can use to get out of your trades. SAR stands for stop and reversal. Parabolic SAR is a method devised by J. Wells Wilder to find potential reversals in the market price direction. We will see the creator of this indicator several times, as this is not the only one he introduced. This is how the indicator will look. A parabolic SAR places dots or points on a chart that indicates potential reversals in price movement. Dots shift from being below the candles during the uptrend to above the candles when the trend reverses into a downtrend. The beauty of this indicator is the simplicity. When the dots are below the candles, buy signal. When the dots are above the candles, sell signal. One of the easiest indicators to use in either direction of the market. SAR is best used when the market is trending. This indicator won't work when the market is choppy and ranging. One of the most powerful uses that this indicator can provide is the signal to exit your trades early. The dots are following the prices. Again, there is a video in the description with more details about this indicator. SAR is a very simple to use and very powerful indicator. Stochastic is another technical indicator that helps traders determine where a trend might be ending. Developed by George C. Lane in the late 50s, the stochastic is a momentum indicator that shows the location of the close relative to the high-long range over a set number of periods. This is how it will look like in your chart. The idea is very simple. During an uptrend, prices will remain equal to or above the previous closing price. During a downtrend, prices will likely remain equal to or below previous closing price. I think you get the idea of why the applied method can be very important detail. Stochastic measures the momentum of price. In theory, the market loses momentum first and after the prices follow. The stochastic uses a scale to measure the degree of change between prices from one closing period to predict the continuation of the current direction trend. The two lines are similar to the MACD lines. One line is faster than the other. Again, you can find the relevant video in the description with more details. The indicator informs us about overbought and oversold from a scale of 0 to 100. When the stochastic lines are above 70 or 80, then it means that the market is overbought. When the stochastic lines are below 20, then it means that the market is oversold. In theory, we buy when the market is oversold, and we will sell when the market is overbought. Again, as I said, you can find more details about this indicator, like formula and so on, in the description below, and how to spot divergence. Unfortunately, stochastic, like any other indicator, is not perfect. The market might remain at the overbought or oversold area for days or weeks or months and keep going higher or lower. So while you will expect the market to reverse, the market will keep moving in the same direction. This is the reason we say that overbought and oversold do not exist. You might see some extreme values even above 90. This is the moment you need to think smart as traders. This might be a signal that we are in a strong trend. RSI, Relative Strength Index. RSI is a very popular indicator developed by James Wells Wilder that we mentioned earlier. The indicator helps traders evaluate the strength of the current market. RSI is a momentum indicator, and again we will use overbought and oversold signals. Momentum is important, and we will see more details in future episodes. The market first changes momentum and prices follow. RSI is similar to stochastic. It's scaled from 0 to 100. Typically, readings of 20, 30 or lower indicates an oversold market conditions and a potential buy. Some traders interpret an oversold currency pair as an indication that the falling trend is likely to reverse, which means it's an opportunity to buy. Readings of 70, 80, 90 or higher indicate overbought conditions and an increase in the possibility of the prices going down. Now be smart in your trading. Remember what we said. When the readings stays above 80, 90, it is an indication that we have a strong trend. So this might be the opposite signal. This is why trading is very tricky and there are no rules. Indicators cannot help you so much, but there is always a proper way to read them. Some traders interpret an overbought currency currency pair is an indication that the rising trend is likely to reverse, which means it's an opportunity to sell. In addition to the overbought and oversold indicators mentioned above, traders who use the relative strong index indicator look for crossovers. A movement from below the center line 50 to above indicates a rising trend. A rising center line crossover occurs when the RSI value crosses above the 50 line on the scale, moving towards to 70, 80, 90 and so on. This indicates the market trend is increasing in strength and is seen as a bullish signal until the RSI approaches 70 or 80 line. A movement from above the center line 50 to below indicates a falling trend. A falling center line crossover occurs when the RSI value crosses below the 50 line on the scale, moving towards to 30 line. This indicates the market trend is weakening in strength and it's seen as a bearish signal until the RSI approaches the 30 line. Of course, you can customize your indicator and add several levels like 90, 95 and also 20, 15 and 10. Again, this is up to you. I think you get the idea on how to trade using RSI. RSI can be used just like the stochastic. The idea is to pick overbought and oversold conditions in the market. RSI can help you also determine the trend. Readings above or below 50 theoretically is the key. A possible uptrend when the RSI is above 50, a downtrend then the RSI is below 50. Again, divergence is a very important factor that we can check in a more advanced version of this indicator. You can check all the advanced version for each indicator we are mentioning at this video in the description below. Developed by Larry Williams, Williams SAR is another momentum indicator that measures overbought and oversold levels. It is similar to the stochastic. Again, we have the same conditions in the market, overbought and oversold. Williams SAR is a momentum indicator that shows you where the last closing price is relative to the highest and lowest prices of a given time period. If you put them side by side, you will notice that Williams SAR is a more sensitive version of stochastic. Again, it measures the strength of a trend. While RSI uses its midpoint figure 50 to determine trend strength, Williams SAR extremes levels are -20 and -80 for signals. In the description below you will find a more advanced version of each indicator and the formulas. Of course, as beginners this is not easy, but you will be able to understand pretty fast the core of each indicator. Stochastic and Williams SAR use the same formula to show the relative location of a currency pair. The only difference is that stochastic shows you a relative location by using the lowest price in a time range, while Williams SAR uses the highest price to show the closing price position. In fact, if you invert Williams SAR line, it will have the exact same line as stochastic. This is why Williams SAR use value from 0 to -100 scale, while stochastic is scaled from 0 to 100. A reading above -20 is overbought, a reading below -80 is oversold. The principles are the same. If the market is in a very strong trend, you will want to follow the trend. An overbought or oversold readings does not guarantee that the price will reverse. Overbought and oversold are abstract concepts. They are derived from some calculations and are some extremes based on a price range for a given period. J. Wells Wilder introduces the average directional index, a popular technical indicator that measures the trend strength. ADX has values from 0 to 100, with readings below 20 indicating a weak trend and readings above 50 signaling a strong trend. ADX is useful to measure the trend strength no matter in what direction the market is going. The strongest the trend, the higher ADX goes. When the ADX low, it highlights periods when the price is usually going sideways or trading in a range. When the ADX has risen above 50, this indicates that the prices are getting momentum. ADX does not determine whether the trend is bullish or bearish. It measures the strength of the current trend. The most important use of the ADX is to identify whether the market is ranging or starting a new trend. This technical indicator is a non-directional indicator. It is based on comparing the highs and lows and does not use the close of the bar. The stronger the trend, the larger the reading. The usage is very simple. The 20 and 40 are the key levels. levels. Below 20, we have a weak trend. Between 20 and 40, we do have a strong trend. And above 40, an extreme trend. One of the ways you can use the ADX is to wait for breakouts. When the market is ranging, while we are in a trend, long or short, ADX can be used as confirmation of whether the pair could possibly continue in its current trend or not. Another way is to combine ADX with another indicator, particularly one that identifies whether the pair is heading up or down. ADX can help you identify when the market is running out of steam. This will help you to exit your trade. Ichimoku may look very complicated to novice traders that haven't seen it before. Once you get the idea, you will understand how useful this indicator is. It's one of my favorite indicators, a multifunctional indicator that finally can also provide potential future price movement. You can find an entire episode for this indicator in the description below, with all formulas and more details. The creator was Goichi Hosoda, a Japanese journalist published in the 1960s. Ichimoku translates to one look or at a glimpse. You need only one look at the chart to determine momentum, support, and resistance potential future price movements. The indicator can show future price momentum and determines future areas of support and resistances in a very dynamic way. 3 in 1. There is a myth that this indicator is mainly used to GPY pairs. But when you will start using it, you will understand that this is not true. This indicator will fail where most indicators would, when the market is choppy, trading sideways, and we don't have a clear trend. There are 5 key components to the Ichimoku indicator. The Kijun-sen is the blue line. It is the standard or baseline. This is calculated by averaging the highest high and the lowest low for the past 26 periods. Tenkan-sen, the red line, the turning line, and it is derived by averaging the highest high and the lowest low for the past 9 periods. Chiku span, the green line, the lagging line. It is today's closing price plotted 26 periods behind. And another 2 lines, Senkun span A and Senkun span B. The first Senkun line is calculating by averaging the Tenkan-sen and Kijun-sen and plotted 26 periods ahead. The second Senkun line is determined by averaging the highest high and the lowest low for the past 52 periods and plotted 26 periods ahead. Again, you don't have to remember this information, and more details for the formulas are in the description. So, how do you trade with this indicator? For Senku, if the price is above the Senkun span, the top line serves as the first support level, while the bottom line serves as the second support level. If the price is below Senkun span, the bottom line forms the first resistance level, while the top line is the second resistance level, a dynamic area of support and resistance. Kijun-sen acts as an indicator of future price movements, and here is one of the unique elements of this indicator. If the price is higher than the blue line, it could continue to climb higher. If the price is below the blue line, it could keep dropping. Tenkan-sen. The Tenkan-sen is an indicator of the market trend. If the trend line is moving up or down, it indicates that the market is trending. If it moves horizontally, it signals that the market is ranging. The Chiku span or the green line crosses the price in the bottom-up direction. That's a buy signal. If the green line crosses the price from the top down, that's a sell signal. Again, this indicator will take you a while to understand. However, everything you need to know is in one chart. This will be a headache, especially if you are a beginner. It will take time to master indicators and decide what to use and in what combination. When you will start searching for indicators, I can guarantee you will be lost. There are thousands of variations and combos out there. You can use a momentum indicator with a trend one. For example, Bollinger and Stochastic. When the market is ranging, we are waiting for the Bollinger. Stochastic provided us with the extra confirmation signal. For those market conditions, they worked beautifully. Another common combination is RSI and MACD, and most likely you will see them in most charts. They seem they work perfectly, but this is a theoretical world. When you will try in the real markets, I'm afraid nothing will work, or at least this will be your first idea. Practice will keep making you better. We will make another episode on types of indicators and combinations in the future. But for now, these are the most popular you will see. Also, in general, a rainbow moving average indicator with a momentum oscillator is the most common combination you will see out there. Remember, we want clear charts and clear line. Of course, you need to make several tests to see what type of trader you are, and this will come in time. At this level, try to understand how indicators work individually before using many of them in your chart. A very good example we have analyzed is Ichimoku. This indicator has several indicators embedded, as we explained, so this is a good place to start. Again, as new traders, searching for the best indicator won't work. The question most new traders start with: what is the best indicator to use? Well, I wish I knew. This is the correct answer. Each indicator has been created for different purposes. Unfortunately, there are no statistics to cover this topic. I do have my own track record. However, the way that each trader uses the indicator varies. For example, a new trader might take a short position based on an overbought condition, but a more skilled trader will go long, as he knows that the market most likely will continue to this direction. Now, both traders took decisions based on the same indicator. You understand how chaotic this can be. Each trader will develop different skills and will use the indicators differently. The best approach is to use the indicators and values that most traders use. We know that the market is a self-fulfilling prophecy, so try to use what most traders use: MACD, RSI, moving averages, and so on. Now combine that information. We already know that 90% are losing money in the market. I know you are lost, and this is how you should be. Trading is risky as hell. In this series and in our live channel, we are analyzing all indicators and all variations with a deep analysis of formulas and how they work. Again, as beginners, you need to set some ground rules to work. This is the reason that we created this series. Step by step, you will understand the basics of the market. Indicators won't help you so much. In the next chapter, you will see why. The market is unpredictable. When we are trading the markets, we do not trade prices but opinions. It is pure psychology and expectations that move the market. This has been depicted in the prices. We will examine psychology in the markets in future episodes. Market psychology is considered a powerful force and may or may not be justified by any particular fundamentals or events. Expectations, fear, greed, euphoria, panic are all factors that contribute to market. These are unpredictable elements and will move the market. Indicators are using mechanistic formulas to evaluate a price condition based on an average set of prices, a specific period, a specific set of prices, no matter what modifications you do. So practically, we try to use mechanistic and mathematical rules in a game of psychology. Human psychology is totally unpredictable. Of course, maths can provide us with more general ideas, and we can use them. In future episodes, we will see more suitable indicators like the golden ratio and several others, but for the moment, we will go step by step. A mechanistic indicator cannot detect future prices. Most of the indicators are lagging indicators and follow the prices. This does not make them useless. Of course not, but you need to understand when to use them in your trading. Remember the overbought condition we explained in our example. The experienced trader saw this as a signal, as a strong buy, as the market will keep moving higher. When the newbie dived and shorted the market, as new traders, you need some rules to enter and exit your trades. Indicator will provide you with those rules. As you continue your trading journey, you will start to get rid of most of the indicators. Searching for the holy grail by adjusting the values won't help. There is no holy grail. Even though the market repeats herself, it's not in the same way. No matter how experienced you are, market will play tricks on you. The key to success in trading is not some kind of indicator. Discipline, risk reward, and money management will move your trading forward. We will see all this information in a future episode. Thank you for watching. Go back, repeat the chapters you are not sure, and trade safe.